Good day, everybody. Despite the various specific and general anti-avoidance provisions aimed at trusts, they remain a popular planning mechanism in South Africa, both commercially and in a family context. Today, we aim to provide you some background not only on the distinction between South African trusts and foreign trusts, or so-called offshore trusts, but we also want to highlight some of the key differences, how foreign or offshore trusts can be used in planning mechanisms, and what the benefits there are for beneficiaries locally in South Africa. Today with me is my colleague Albertus Maree, and Albertus, I want to kick off the discussion between when we say a foreign trust or offshore trust, how is that distinguished from a South African trust? Do we look at where trust instruments are created in different jurisdictions? Can a South African trust automatically be a foreign trust? What's the essential difference between the trusts?
Yeah, and it's probably one of the most common questions that we receive is I've had so many clients who walk in the door and tell me that they have an offshore structure and they want to move assets to that structure. I'd ask them, where is that trust set up? They'd say, no, they are the only trustee and the trust is in Mauritius. I say, oh, okay, it's a problem that you're the only trustee, but we can get to that in a moment because I think there are question marks whether you aren't really the puppet master or the alter ego of that trust, so really the assets are your own. But secondly, where the trust is managed from. So, I mean, you go to Mauritius quite often, obviously. So, no, I've never been to Mauritius. I said, well, then I've got a surprise for you. You don't have a trust in Mauritius. For tax purposes, an offshore trust needs to be effectively managed from there. It means that you need to have your trustee meetings there. You need to go there physically. You can't dial into meetings. So, that is the difference from a tax perspective, is where's the thing effectively run from? Where do the trustees take their decisions on who to bank with, where to invest, when to sell, who their auditors would be, etc. Quite a number of South Africans opt for offshore trusts, not only though for tax reasons, but also for exchange control reasons. And the exchange control residence of a trust is of course not the same as for tax residence. It takes a more formalistic approach. For exchange control purposes, we look at where the trust is registered or formed. Now, if you have a trust, for example, that you've formed or that's been registered in Mauritius or whichever other jurisdiction, and your trustees also meet in that country exclusively, or at least by far in the majority of cases, then you have an offshore trust, both for exchange control purposes as well as for tax purposes. Why that is popular is quite a number of clients would prefer to have assets outside of the South African exchange control net, to have liquidity and exposure linked to dollar and euro denominated assets. And secondly, of course, a number of these offshore jurisdictions has the benefit that it has quite a low or beneficial tax regime in place. Mauritius is quite popular for the reason, firstly, that it is quite close to South Africa in proximity, so it's easy to travel there and to hold your trustee meetings there. And secondly, of course, it has a double tax agreement in place with South Africa. In other words, what is taxed in Mauritius will not, in most cases at least, be taxed in South Africa either. And to the extent that there is potential for double taxation, those are at reduced rates typically.
I think the comment that you made around maintaining control or effectively managed really emphasizes the point that I cannot have a trust, or it's not my trust, where funds or assets are contributed to a trust. You essentially relinquish control over those assets. So it's not your trust necessarily.
If I can, interrupt you on that point, it's extremely important for a number of these foreign jurisdictions, especially in the Channel Islands, Jersey and Isle of Man and the like, have these so-called settler capacities also introduced to trusts. The question, what powers the settlers have over a trust instrument is extremely important for exactly that reason. It's to say that, can you as an individual still really control the instrument, pull the strings from behind the curtain, so to speak? Of course, our law is substance driven, not merely form based. So if in substance you are able to control what happens in that trust instrument, the risk, and the very real risk exists, that those assets are, legally speaking, not that of the trust, but is your own, which of course nullifies the whole purpose of having an offshore structure.
But there's of course also certain reporting mechanisms that are in place. You refer to the exchange control mechanism. Specifically from an income tax perspective, SARS has a regime that's referred to as reportable arrangements, where there are certain transactions are reportable to SARS where the transactions meet certain criteria or are subject to certain restrictions or transaction flow. But there's also in a public notice, SARS has issued a number of specifically reportable arrangements. As it relates to foreign trusts, is there any specific reporting criteria on local taxpayers in respect of foreign trusts?
So the reporting requirement is for South Africans who contribute assets to a foreign trust to an amount of 50 million or in excess thereof to report those arrangements to SARS. Now, firstly, it's important to be aware thereof that there is a reporting responsibility on such contributors of funds to offshore trusts, not only to ensure that you comply with the requirements, but also for us to understand why those reporting requirements are in place. It is an obvious red flag for SARS. It's a so-called suspect transaction to confirm that all the tax consequences thereof are reported and accurately adhered to. Primary among these is the loans to offshore trusts. Now, it's quite difficult to externalize funds and to place assets under the control of trustees who operate an offshore trust. The typical manner in which to do so is to extend loans to that jurisdiction. Now, what very few people realize is that that loan cannot be interest-free because it is cross-border to a friendly party or a so-called connected person. Such interest-free loans, of course, draw the ire of SARS simply since it erodes the South African tax base. What SARS therefore wants to see is, from a so-called transfer pricing perspective, is that interest is levied on those loans. The reason being, of course, that SARS wants the South African to receive interest on the loan that it extends offshore and to receive interest on an arm's length basis, which SARS, of course, can levy tax on. And that is something that quite often is amiss and which taxpayers are required to put in place, especially not necessarily from the start, although we advise that they do so from the start, but we are quite often confronted with a problem where taxpayers weren't aware of the transfer pricing requirements to levy interest, and in which case we are called upon to do a so-called voluntary disclosure application on behalf of those clients.
Let's quickly talk about CFCs, or so-called controlled foreign companies. That's essentially a mechanism, an anti-avoidance mechanism that's in the Income Tax Act, where certain income that has been received by a person in a foreign jurisdiction gets imputed into the taxable income of a South African person. Now, the mere definition itself talks about a controlled foreign company. To what extent can a trust be a controlled foreign company, if at all, and what mechanisms are there, or planning mechanisms are there, having foreign trusts in a so-called CFC scenario?
Sure. So, Peter, 3 comments there. The first is that, and I think the name gives it away, is that the controlled foreign company regime in Section 9D of our Income Tax Act applies only to companies and not to trusts. The second is that a controlled foreign company is an entity, a company, that is being held through a majority of South African shareholders in a low tax jurisdiction. That is typically what it involves. When that happens, the income of that company is attributed directly to the South African shareholders. In other words, it is an anti-avoidance mechanism to ensure that South Africans do not invest in passive instruments in a low tax jurisdiction, such as the Channel Islands or Mauritius, and then escape South African income tax as a result. Section 9D effectively imputes the income of those companies directly into the hands of the South African shareholders. And it is for that reason, and that is the third comment, why offshore trusts are quite popular to hold investments in these entities. These trusts are quite often referred to in tax parlance, if you will, as CFC blockers, because simply now no South African shareholder exists. South African beneficiaries exist of a shareholder, which is an offshore entity, which holds the shares in that company. And why that is important is not only from a Section 9D perspective, but it's also, of course, required in terms of South African exchange control for that structure to be maintained. The reason being that South African trusts are not allowed under any circumstances to hold shares in any foreign country or any other assets offshore for that matter.
It certainly appears as if foreign trust is definitely, from a South African perspective, an absolute minefield when it comes to both the regulation thereof, the initial incorporation thereof, and the subsequent tax consequences, not only from a tax technical perspective, but from an anti-avoidance and reporting perspective as well. And I think you join me in the comment when we say that when you are involved in such foreign structures, that it would be best suited to obtain the appropriate advice to ensure that not only the tax side of the structure is properly addressed, but very importantly also from an exchange control perspective.